Welcome to this episode of our property investing channel. This is your host, Amisad, and today we're going to be talking about property investing structures. To explore this topic, I have invited Sonia Dhillon, who is the founder of Smart Business Advisor Australia with many years of experience in accounting. So without further ado, I'd like to welcome Sonia to our show. Sonia, thank you very much for being here.
Yes, thank you, Amir. Thank you for having me.
My pleasure. Just to start with, can you tell us a little bit about yourself, your experience and your journey?
Yeah. I came to Australia in 2006 to study accounting and never looked back since then. I finished my CP and then started working in public practice since the beginning, since I finished my accounting degree. Initially, I started working in manufacturing. I was working as a purchasing officer, moved on to assistant accountant within the finance roles. But always public practice and tax always interest me. And I always had been working part-time as a tax accountant as well. And the love for tax I moved into public practice, left my corporate job, worked with tax planners for some time. And then I started my own practice, Smart Business Advisors, in 2018. Initially, we started with bookkeeping, and that brought in the demand for CFO advisory services, as there was a gap between tax accountants and small business owners. For tax agents, they will take care of compliance and bookkeeping. Compliance and bookkeepers will just do the books. But as a business owner, you want to know a lot more about your business than just your compliance obligations. And this is when we started incorporating advisory along with tax services. And most of our clients we have are property investors, mom and dads who have property portfolios, and we deal with property development projects as well. That's how my love for property and tax came into picture, and that's why I'm here.
Fantastic. I'm sure that you can add a lot of value to our audience today. So just to start with, let's talk about investing structure. So why do property investors sometimes prefer to use another structure instead of buying under the personal name?
Yeah, look, Amir, it depends upon the investing structure is very personal, I would say. Investing structure is when you want to be proactive in your approach towards property investment and investigate different structures before you dive into investments in the property. It depends upon what your short, medium, and long-term goals for your investment. Some of our clients wants to have few investment properties and sit on them until they retire. For them, we recommend a different structure, whereas someone might want to sell it within 3 to 4 years' time, make money and move on to another property development project. Or someone might want to start a property development project with few other investors. So it depends upon personal preferences. Although first question that we ask when deciding about best structure for development projects is whether land is already acquired. If so, then this may restrict the structuring options available. And also other tax issues such as the sale of any property will be on capital account or revenue account as well. That also impacts the GST implications. So we recommend if you're planning to get into the property investment side of things, you need to be proactive even before you acquire a land or before you go and sign any paperwork. Just think of the best tax structure for yourself.
Absolutely. And it can impact in a lot of different ways in terms of asset protection, in terms of tax minimization. Yeah, so it really can make a big difference to investors, and they really need to get professional advice before they decide to purchase anything in the first place. So correct, if they purchase something, it's just too late to decide.
Too late, yes.
That's very important.
And we do get lots of clients, such as recently we had a client wherein they had an investment property. Mom and dad, they bought a property and they didn't live in the property, and that was just the investment for them. They came to us after they sold the property and they said, what are the CGT implications? We said, well, it's too late now. We can't do much. And or someone might come. We had another case wherein a couple, they actually subdivided their block of land. They were actually living on the land and they thought that they will get the exemption because this is their primary residence. but that wasn't the case. And
Absolutely.
Those surprises can be very, it can hit your pocket very bad. So you need to be proactive before you decide.
Yeah. We really don't want to be in a situation that we are really surprised by the impact of not selecting the right structure in the first place.
Correct.
So we talked about why we need to understand which structure is working the best for us, but what the structure can be used by investors, and what are the pros and cons of each of these structures?
So there are different structures, such as on your individual name. Then you can go into a partnership as well, wherein you do a partnership and do a development project together. Then the other one, you can go into a joint venture arrangements. And obviously, we all know about company and trust structure. Or you can have a mix of both the structures, such as we recommend sometimes our clients to go into a trust structure with the trustee as a company. To avail the corporate tax rate and to avail different other discounts that you can get. While deciding on the best structure, you need to be aware of following factors. One of the factors that you need to be aware of is cost and complexity. Sometimes you might, when you're going into a property development project, you might think which structure you need to go by, but you need to be aware of what the cost implications are and what are the complexities that involve. Then the other thing that you have to be aware of is risk associated with different structures, such as you mentioned earlier, the asset protection. When you're diving into property development on your individual name, you are exposing yourself to not having any protection for the property development assets that you have in your name. So that's a very big risk associated. That's one example. There are lots of other risks that can be associated on what structure you decide. And as I mentioned in my previously as well, the personal circumstances. So when you're deciding the structure, you need to know about your personal circumstances, how far you want to take property development. Is this something that you want to take on as an active property development business? You want to have it as income producing on regular basis, or you just want to do one-off, such as I mentioned earlier, one of our clients, they just had a big block of land. They had their primary residence on the same block. They decided to subdivide and sell off half of it. So it basically comes back to your personal circumstances as well on deciding which structure to go for. Now, there are a number of tax issues to keep in mind when deciding on what structure to use, such as tax rate of the structure. The corporate tax rate that you get is, as we have 25% corporate rate, such as the individual, if you're buying something on your personal name, yes, you do get 50% discount, but whereas let's say we recently had a scenario wherein the couple were already above 100,000 of income individually. And when it came to the profits out of the property, they went into a really high marginal tax rate.
Absolutely.
Yeah, so tax rate also implication is one of the implications. The other implications you cannot ignore is GST. CGT and stamp duty cost associated with what structure you go by. Sometimes you might decide, as you bought a land and you think, I want to, it's in my individual name. No, I want to change the structure and I want to put it into a family trust. You have to be aware of the stamp duty implications as well. Then GST is one of the a very big issue. We had one other client that came to us. They had subdivision, they did subdivisions, they built the units and they were selling the units. And when it came to a final stage, we received an email wherein it was about paying the GST, which was a big, big bill for them.
Absolutely.
And yeah, so that can also impact. Now, it depends upon whether an entity can access the 50% CGT discount as well, and the ability to stream income into different individuals within the family trust as well. That also makes an impact on this. Yeah.
So please correct me if I'm wrong. Only trust and personal entity can use that 50% on CGT, right?
Correct. Yeah.
But company, if we purchase something on the company structure, there is no CGT.
There's no CGT discount, no. You cannot do that under the company structure.
Okay.
But again, it comes back to under the CGT discount is whether the property development business you have is on an income account or it's a revenue account or a capital account.
Sure.
So it depends. Basically, if someone's running it as a business, there's no CGT question in place. It's all revenue account. Yeah.
So development projects are basically business based, and that's why they cannot get CGT discounts.
Correct. And the GST implications also come into place for residential properties, new residential properties. Yeah.
Sure. So what are the risks of purchasing a property on the partnership structure? This is a question I really wanted to ask you, because I've seen so many people, especially with the increasing cost of properties, they decide to enter a partnership and buy something together, and they use partnership structure. So can you tell us a little bit about the risk of that partnership structure and how can that be avoided?
With the partnership, we don't recommend going into a partnership structure just on itself. Whenever someone comes to us and they're a group of friends or 4 or 5 people coming together and doing a big development project, the first thing we say is you go into a unit trust structure in which one of the benefits is there's an easy entry and exit in a trust. That you can, let's say, for example, you have 4 partners who come in together to do a property development project, and you want to add more partners in, you can easily do entry and exit. The other thing that it helps is with the asset protection. So let's say one of the partner is running other businesses as well. And if you're going into just a partnership, legal partnership structure, whereas compared to a unit trust, you can be exposed to the risk associated with other partners doing business on different other platforms. So it can impact your assets as well. Whereas if you're working under a unit trust, and we recommend doing a unit trust structure with further flowing that income into your individual family trust. That is the best structure that we recommend when you're going into a partnership with someone.
Perfect. So in a nutshell, purchasing a property using partnership structure is very, very risky because they don't have that asset protection because of other parties involved, and they can be affected from the other partners.
Correct. And in the partnership as well, you don't avail the corporate tax rate. Whereas in a unit trust with the trustee company, you actually avail the corporate tax rate rather than going with the marginal rates. Whereas if you're doing a partnership, you actually are exposed to the marginal tax rates, depends upon the individual bracket of income that you have.
Absolutely. And that makes a very, very big difference at the end of the day. Yeah.
Big difference, yeah. Sometimes you don't sometimes you don't incorporate all these costs associated, but when you see at the end, if you don't pay attention to these details, it can cost you big. You can actually not have profits out of your development project. You end up paying more out of your
basically
pocket.
Paying 46-7% to taxman is not a good thing.
Yes. I was surprised when we had that meeting with a client and they said, oh, we just are on a higher rate, but we sold our property. And sometimes we told them, we were like, maybe if you came to us earlier before you sold the property, we could have recommended holding on to the property for some time, or wait for personal circumstances to change and stuff like that. But it gets too late. Yeah.
So before we move on, since we are on this topic, many people try to use the benefits of tax reduction using negative gearing because they can offset their losses, property losses against their income, and they reduce the taxable income so that they can save tax. What is the tax implication if they decide to sell the property? I just want to, make a very clear statement on the tax implication when people buy something under their personal name and they decide to sell in a few years' time and they have a good profit out of that property.
In relation to the negative gearing, you actually have a negative gearing is in relation to, let's say, I'll give you an example. Let's say you are on income of 120 on your PAYG, and then you have an investment property. In that investment property, you have your income coming in, the rental income, but whereas the interest and the other deductions are way more. And then let's say from the investment property, you have a 20,000 loss that can be taken off against your taxable income, which is, as we said, 100,000. So you pay tax on 80,000. Whereas when you sell the property, any of the deductions that you have already claimed, when we actually do the CGT at the end of when you did the profit and loss, it basically depends upon, we cannot avail the deductions that we have already claimed in the last years. So what we look into deciding on the profit is whether you lived in that property, and if you did, how long you lived in the property, because you do get exemption for that particular time frame. And moreover, when we are doing the deduction, when we take the cost base, let's say, for example, Amir, you bought an investment property. You bought a residential property. You moved into it for 3 years. Then you decided to move out of the property and you decided to rent it out to someone else. So you get the 6-year exemption, primary residence exemption. But for 6 years, you have the exemption. But when we calculate the CGT at the end of when you're selling the property, we take the market value at the time when your 6-year rule expires. So we take so that means your cost base of the property goes up, which means your profit will come down. So it basically comes back to, yes, you do pay CGT, but it definitely makes a big impact on whether you lived in the property or you always had the property just for your investment purpose. In that case, you lose that exemption that you can calculate on the basis of as your primary residence when you lived in the property. Yeah, and then there are other costs associated with lawyers and stuff. So, and plus 50% discount in the end.
Sure. So if a person bought an investment property under their personal name as a pure investment property, what is the tax implication when they sell their property?
They will have to pay the whatever the profits that they have made. They'll have to pay tax on that, but they'll be 50% discount because it's a CGT 50% discount they get, and then it gets added on to their other income. So it goes on to the marginal tax rates. They can be on the higher bracket.
Sure. And that is where they realize that, they have to pay a lot of tax.
Yeah, correct. Yeah.
Okay. So we talked about trust a few times as one type of investing property structure. So what is the difference between individual and company trustee?
Well, with the individual, as we discussed earlier as well, one of the main benefits of doing it under a company trustee is actually in relation to getting you actually avail the CGT discounts as well that you do in individual as well, that's there. But one of the biggest implication is a tax rate. You go on to a higher tax bracket. Look, if someone is not earning anything else, there's no other income, then in that case, they might not be hit that badly. But whereas under a company trustee that they use, in that case, they can actually avail the discounts and they go on to corporate tax rate rather than the individual tax rates. That's one of the biggest benefit that you have. And the other thing, as we know, the asset protection is there. Whereas in an individual name, if you're running a business or if you are running other different investments on the side, then it can impact your personal assets as well. If it goes down, if something goes wrong, and then it can impact your personal assets. Whereas in a unit trust, you are to some extent protected in a company trustee, but not 100%. But as compared to the individual, you are protected. Yeah.
Perfect. So two implication. One is tax implication. The other one is asset implication. And the company provides that asset protection and tax benefit at the end of the day.
Correct. It's the trust. It's a trust that provides asset protection. Company is a trustee for that trust. And further, if you put that into if you park it into your family trust, you can further distribute the profits within your different other family members. that can also help. Yeah.
Which basically you transfer the profit to the people with lower taxable income, so that they basically can reduce the tax at the end of the day.
Correct. And the maximum exposure, when you're doing under a company trustee is, the maximum exposure to tax is only the corporate tax rate that you are exposing yourself to. With the individual family members, if you see any of your family members are above the corporate tax rate, then we don't recommend distributing to them. But someone who's below the corporate tax rate of 25%, you can actually distribute it further to them. And yeah.
Absolutely. A very valuable vehicle for reducing tax.
Correct. Yeah.
We talked about trusts. Let's talk about company right now. When is it appropriate for property investor to use a company structure for their investment, or is it appropriate at all in any sort of cases?
Company structure, look, it again comes back to your personal preferences. We don't recommend having a company structure without a trust associated. Just a company structure, we don't recommend, because as I mentioned, it depends. If you just want to run a business of property development, and you just want to make properties and sell the properties as a builder, then we recommend, have a company structure, use a company structure to do your business. But in property development, that's not something we recommend. We recommend having a unit trust associated with the company structure, because unless you have a lot of capital, you won't need other investors to come in, because you cannot, in a company structure, there's no entry. It's not easy to do entry and exit for someone who's not part of that company from the very first day.
And for a buy and hold strategy, basically, the company cannot have that CGT discount, correct?
Correct. Yeah. But company can be used if it's just your business, if you're just running a business of property. That, as I mentioned, unless you know right from the beginning that you're two people and you are using only your capital in running a company business, in running a property business under a company, and you won't need any other investors, and you both trust each other 100%, and you're two brothers, you want to come together, you can go for that. But there are implications. There can be lots of implications using a company for property development. We recommend, let's say, for example, two friends coming together doing a property development. They open a unit trust as a company trustee, do that property development project, and pay the taxes, pay GST, whatever implications, close that property development unit trust, move on to another unit trust for another project.
Cool.
Yeah, let's say, for example, me and you come together to do a property development project together. Then another one, I finish that off with you. I want to do another one with my sister or my friend. But again, it comes back to now ATO looks clearly into, back in the day, it used to be, if you have a unit trust together, like you and me coming together in a property development project, we both can do a project together, and then we close a project, it's wind up, and we move on to another project. Then it was looked upon as a separate project, and it was a CGT, it was on capital account. Because Amir, keep in mind, the CGT discount that we talk about is on the basis of that it's actually a capital account. Whereas if ATO comes, if it comes to a picture wherein that it is actually your regular business, then you won't get the CGT discount. Then it will be on revenue account. So you have to bear that in mind. Back in the day, it was entity basis, one unit trust. We have done business together, we sell, and I move on to another business, another unit trust with a property development project with someone else. But ATO will look at me individually. If I have been doing this on regular basis, there can be a question of whether you can put that onto a capital account and avail the discounts. So we have to be very mindful of how we structure our property development project. Yes, you do get CGT discount, but it depends upon whether you fall into that definition individually or not. That can that we need to keep in mind as well.
That was a very, very interesting point that you mentioned.
Yeah.
Thank you for mentioning that. We talk a lot about tax reduction, CGT, and asset protection. How does selecting a structure can impact GST?
Yeah, GST. That's a very good question. GST is technically sale of new residential premises is subject to GST, as we all know. GST topic is so vast within property development that we can discuss this on a separate interview so that we do not miss out on any important information for our listeners. Again, in deciding whether transaction is on a capital account or revenue account can be used to determine the GST implications. So when you're thinking of one-off capital account, it depends, then you might not be subject to GST, but as per the new rulings, any new residential premises is subject to GST. Now there are a certain, let's say, for example, I'll give you an example. Someone has already got motel, and that motel got really old residential small units that they have. Now they're deciding to sell those as separate residential premises. When they sell, they are subject to GST. So it depends upon new residential premises and old residential premises. The definition is very vast. As I mentioned the example, someone might come and say that, yes, I had an old motel and I'm selling my old residential premises. No, that's subject to GST as well. So there are lots of loopholes within the old and new premises when you talk about the GST implications, which is way vast. I'm happy to do another discussion just on GST, which can be very eye-opening.
Yeah, absolutely. The very, very good points that you're mentioning. Not so many people know about these things, and that is why it is very, very important to get financial advice and get a good advice on the structure that they're selecting before they do anything.
Correct. And being proactive is very important. When you're diving into property investments, just be very proactive. Just talk to your consultant, discuss what your long-term, short-term, mid-term, and long-term goals are, why you're getting into property investment, what do you want to achieve out of doing the property investments, and how much are you looking at getting out of as a return, and then decide the structure and the parties involved and so on. You need to know everything so that it can be a smooth ride for you.
Absolutely. Lots of valuable information. Really, really great. Thank you very much, Sonia. How can people find you?
They can find me on LinkedIn. I'm on LinkedIn, and I think I'm in one of your followers as well. I follow you.
Yes. Oh no, I follow you.
So the other is we have a website, but we are still working on a website to target to actually put into place some of the more blogs around property development. Our website is www.smartbusinessadvisors.com.au, and that's where you can find us as well. We have our social media handles as well. If you look us up on Facebook or Instagram, you can contact us there as well.
Thank you very much, Sonia, for being here today. I really appreciate you.
Thank you, Amr. Thank you for having me. It's
My
such a pleasure.
So if you've liked what you've heard today, please like our channel and leave us a comment. And on that note, this episode is a wrap. We'll see you guys again very soon. Bye for now.